So again, it's a great pleasure to be here. So as the European policy-making machinery kicks into action again after the summer break, I welcome this opportunity to share some thoughts with you. The question that has been put to me is how much more deepening of the economic and monetary union is needed. This is a big one. It's a big question, and there's no simple answers. My approach today will be to focus on the core issue of private risk sharing. I want to discuss what it really means and what holds it back, and what concrete steps can and should be taken to push it into higher gear. Recognizing that every roadmap needs a destination, I also want to lay out briefly first our vision for a true financial sector union for the euro area. So in what follows, I will discuss banking union and capital market union. But I will also try to advance the debate one step further by discussing a truly integrated financial market union, a union that can be more than the sum of its parts. And this is what I'm saying now is important. When I focus on finance today, as I will explain, it is because this is an area where I think meaningful progress is within reach, where progress can be taken in the current environment in small steps. Much work, I believe, can be done on this within the confines of the current political realities. We are not talking about treaty changes here. We're talking about letting the technical experts hammer out mutually acceptable compromises. I will return to this. Just wanted to explain why this is my angle. But before I come back to this, let me first spend a few minutes reminding you of what we at the IMF see as the end goals for a complete monetary and economic union. When we look to the medium term, we envision a euro area architecture equipped with a full complement of public and private risk-sharing mechanisms. In the fiscal area, we advocate for the adoption of a modestly sized yet potentially powerful central macroeconomic stabilization capacity. In the financial sector, we support putting in place a common deposit insurance scheme and a common backstop for both bank resolution and deposit insurance. As we have argued, such risk-sharing mechanisms need to be carefully designed to ensure incentive compatibility. And by this I mean that every step towards greater risk sharing must be accompanied by parallel steps toward greater risk reduction. The future configuration should be one that carefully balances individual responsibility with solidarity, both at the level of member states and a level of private financial institutions. There is, in my view, no other way forward. Let me be very clear at the outset also what I mean about individual responsibility. No amount of progress on the common architecture in the coming months and years will fundamentally change the fortunes of euro area member states when the next major shock or downturn hits. I have said that often during the last year or so. Resilience will continue mainly to rest on fiscal adjustments and structural reforms at the national level. Here, unfortunately, we see far too much complacency. Let me be direct. Progress on banking and capital market union, even on a central fiscal capacity, will not prevent some countries from having to undertake significant pro-cyclical tightening in the next shock or next downturn, unless they make much better use of the current good times, and they are still good times, to undertake stronger fiscal adjustment. In particular, of now the 5 or 6 countries with debt at 100% or above, we need generally to see stronger fiscal consolidation at this strong point in the cycle. Similarly, while there was a push for structural reform during the crisis, the momentum has waned, and here too we don't see enough action at the national level. It is critical that all member countries respect the Stability and Growth Pact. It is critical that our friends in the European Commission enforce these rules consistently. Yes, the rules should be simplified. We have seen the proposals by the French and German Council of Economic Advisors in recent days. I haven't seen the details, but what I have seen is very much in line with what we have been advocating, and we are supporting this. But this is admittedly not an area that appears to be a strong political priority at this juncture. We don't see much movement happening there. On fiscal risk sharing, in contrast, there is an ongoing dialogue on a common euro area budget or some mechanism to support public investment in individual countries. While we see the recent proposals falling short of the full-blown counter-cyclical facility that we and many other observers consider critical for the long-run stability of the Eurozone, significantly short of that, we certainly are encouraged that this discussion is going on and that the discussions continue. As many of you know, earlier this year, we, the IMF, waded into this debate by tabling a proposal of our own for a central fiscal capacity. Let me emphasize that we very much view this as a proposal not just to establish an element of public risk sharing, but also to improve compliance with the fiscal rules. As I mentioned before, this was a problem. Our idea, quite simply, is that it should be possible to bridge the gulf between those who are calling for greater fiscal risk sharing and those who worry more about moral hazard and permanent transfers, to explicitly link central support for economic stabilization to fiscal risk reduction, that is, to better compliance with the fiscal rules. Our proposed fund seeks to encourage saving by member states with limited fiscal space, to encourage them to build buffers by requiring regular contribution from all euro area countries, while at the same time making transfers conditional on compliance with the fiscal rules. By having transfers triggered automatically by a readily observed cyclical indicator linked to unemployment, our proposal explicitly sets out to smooth macroeconomic risk. The analysis, and you can find it on the web at imf.org, shows that a fund financed by a relatively modest annual contribution from member state, say about 1/3 of 1% of euro area GDP, would act as a powerful stabilizer. It would not substitute for national fiscal responsibility, nor completely offset large shocks, but it certainly would help. Moreover, in the event of very large shock, there will always be the role for ex-post risk sharing through official assistance subject to policy conditionality provided by the ESM. Now, we understand, of course, that Europe is not a political union, and agreeing architectural changes of this sort is complex business. From such a perspective, then, our proposal might appear unrealistic, despite explicitly making access to transfers conditional on obeying the rules. But even if it takes time to build consensus, we are convinced that greater fiscal integration in the Eurozone will eventually only happen by bridging this fundamental divide between risk reduction and risk sharing. Our proposal is just one way to build this bridge. This being said, let me pause for a brief reality check. Not long ago, there had been signs that Brexit and broader geopolitical challenges from both the East and the West might breathe new life into European efforts to take major fundamental political steps to advance work on the Eurozone architecture. I certainly still hope this will be the case, but it appears that major path-breaking initiatives are not likely at this time. We see undercurrents of discontent and Euroscepticism feeding into poll results across the Union. We see basic challenges to the European project, challenges that governments, new and old, cannot afford to ignore. We see at best a limited consensus of what comes next. Frankly, the June summit delivered an outcome that fell short of the elevated hopes of only a few months earlier. I think, therefore, it is right for me to focus today on what we consider achievable changes, even in the current political context. So my basic premise today is that it's vital that scarce political capital be used well to find achievable wins and lock in meaningful progress wherever it's possible. We have long argued for more public and private risk sharing. Both are essential. As I say, I think that facilitating private risk sharing should be the focus right now because it falls into what I think is politically achievable. So, what do I mean with private risk sharing? It's often, it's often mentioned but explained rarely. What does it mean? There may be different definitions, but I refer quite simply to the diversification of risk exposures by financial intermediaries in the euro area across both national borders and economic sectors. I mean moving to a union where equity capital in one jurisdiction can support prudent risk-taking in another jurisdiction, where deposits in one country can fund sound lending in another, and where financial and non-financial firms alike can issue equity and debt into a European capital markets to a European investor base. I mean making another push, if you want, to achieve finance without borders. Let me start then with banking. Everywhere in the world, banks sits at the heart of finance. Even in the jurisdictions where capital markets are the most developed, and here I refer, of course, to the United States, bank exerts an influence that extends far beyond their relative share of financial sector assets. Modern banking groups are complex animals. Some units of the groups focus on the bread and butter business of retail banking, accepting demand deposits and making loans from relatively standardized consumer credit lines or residential mortgages to more bespoke commercial real estate or SME financing. Some focus on trade finance or automotive finance or credit cards. Some units focus on buying loans and bundling them into special purpose vehicle structures, earning securitization fees, and raising a wholesale fund. Some units focus on managing proprietary trading portfolios of securities and derivatives, so forth and so forth and so forth. I could go on, but I think my point is made. In the real world, there are no neat dividing lines between banking and the capital markets. In the real world, bankers often run non-bank financing. Let me be clear, banking is the pivot of finance. It is therefore appropriate that Europe has pursued banking union in advance of capital markets union. Anything else might have put the cart before the horse. Having explained why I want to start by discussing banking, let me spend a few minutes recollecting the past. While this will be familiar ground to most of you, the 10th anniversary of the global financial crisis should be a time to pause and reflect on the road traveled. Tomorrow I'll be giving a speech in Reykjavik on the 10-year anniversary of the Icelandic program, so there are a lot of anniversaries coming up right now. In its old pre-crisis configuration, cross-border banking integration in the EU relied heavily, as you know, on passporting, whereby any bank incorporated in any member country enjoys permission to establish branches in any other member country. Under the old model, however, there was a dangerous disconnect between cross-border banking activity and its oversight. Back then, the responsibility for official oversight of cross-border bank branches within Europe rested almost entirely with the national supervisors in each group's home country. But this model, built around supervision as a national competency, allowed some national supervisors to favor their own so-called national champions, tolerating excessive asset expansion and risk-taking both at home and abroad. What developed was a macro-significant flow of funds within the euro area, where, of course, there was no currency risk. The highly rated, too-big-to-fail so-called core banks enjoyed strong liquidity for at least three reasons. First, they were seen as a preferred destination for European retail savings and wholesale funds. Second, they increasingly attracted petrodollars post 9/11. Third, they actively borrow in the US credit markets, including to raise dollar funding to finance their large US securities portfolios. One can think of this as a sort of transatlantic wholesale funding pipeline. At the fringes of this great funding game, cheap euro liquidity was also channeled to euro area countries hungry for more credit. There it helped finance cheap lending on increasingly lax terms, lending that in many cases inflated unsustainable local asset private bubble. That was the old banking union model. Then, of course, came the day the music stopped. To be precise, that was 10 years ago tomorrow. We all remember it was a Monday in New York. Lehman Brothers filed for bankruptcy, and an event that, as you know, would send shockwaves around the globe. With a force no one could have predicted, wholesale funding market froze all over the world, trade financing collapsed, good and service trade fell off the cliffs, and banks stopped to drop like dominoes, and financial coffers were forced open. Almost immediately as Lehman went down, European authorities rushed to intervene its European subsidiaries before liquidity and collateral could be spirited away to the parent. Then IEG very nearly collapsed. Then the US money fund industry suffered a run. It kept getting worse. By the end of September 2008, Wachovia, the fourth largest banking group in the United States, required government money, while in Dublin, the authorities issued a blanket guarantee to the entire Irish banking system. In mid-October, the US government announced the blanket guarantees of its own and moved to force-feed taxpayer capital into the 9 largest US banks holding companies. All across Europe, there was a chain reaction of emergency taxpayer support. Everywhere, money ran for the perceived safety of home. Parrot funding of cross-border bank branches within Europe disappeared overnight, precipitating credit contraction, asset price collapses, and deep recession in the host jurisdictions. And so, in the space of just a few weeks in late 2008, the old European banking union gave way to a harsh new reality of home bias and cross-border fragmentation, with most national authorities preferring to host highly capitalized cross-border bank subsidiaries rather than cross-border branches. Much of this reality remains in evidence today. What did Europe do in response? The short answer is a lot. Leaders came together to mandate the construction of a new and better banking union. In the relatively short period since the Apex decision in June 2012, Europe has traveled a great distance. I find it truly remarkable to note that as recently as 6 years ago, there was no single supervisory mechanism, no single resolution mechanism. A lot has changed. Today, Europe has a central bank that has a formidable banking supervision arm, and the Single Resolution Board is an emerging piece of the European institutional setup. There can be little doubt that the operationalization of the SSM has fostered a steep improvement in the quality of banking supervision across Euro area. Joint supervisory teams assigned to all major European banks comprising both national and ECB personnel, always headed by an ECB bank supervisor. This, among all the new supervisory features, greatly limits the scope for the bad old national champion approach. And we have seen from the various bank failure cases over the last year or so that the fledgling Single Resolution Board is learning to implement the new rules embodied in the ESM regulation and in the Bank Recovery and Resolution Directive, the BRD, without triggering major adverse spillovers. Where once taxpayer bailouts were commonplace, there is a growing insistence that bail-in needs to happen, that private stakeholders must be made to pay the price for risk-taking gone bad. Taking these broad observations together, I can easily say that the cup is half full. But the cup is also half empty. There is a lingering impediment to a truly integrated banking union, an issue that has become better understood over time. It's called ringfencing. What does ringfencing mean? It means, in a nutshell, that countries do not yet fully trust the new supervisory and resolution arrangements, despite all the progress made. Quite rationally then, national authorities seek to protect their economies and their taxpayers by ensuring that banks maintain sufficient capital and liquidity within their own jurisdictions. The problem is, however, that such defensive measures also tend to limit the free flow of capital and liquidity across borders and thus act as barriers to a fully integrated banking union. The SSM and the SRM are by construct dependent on national resources and fragmented national rules, which limits their freedom of maneuver. Member states, in turn, neither fully trust the ability of the SSM to ensure prudent behavior in banking, nor the ability of the SRM, the Single Resolution Mechanism, to properly charge back the cost of bank failure to the banking industry. Given these doubts, national authorities still erect barriers to protect their economies and taxpayers. Especially in the host jurisdictions, they take steps to ensure that if banks within their borders fail, then they fail with enough remaining buffers to limit any potential need for fiscal support. But this self-protection stemming from national fiduciary duty stands in the way of the single banking marketplace. It acts as an additional impediment to cross-border mergers and acquisition. It leaves large banking groups asking why they must pay large sums as resolution levies to the Single Resolution Fund, yet they still do not enjoy some of the fruits that the banking union was supposed to bring. Arguably, such groups charge their customers more than they would if they were better able to move their capital and liquidity across jurisdictions. So what remains to be done? To bring some structure to this, I would like to propose two axes of attack. On one front, a push to scale back member states' ability to ring-fence, and on the second front, an effort to reduce their incentives to do so. Let me elaborate on each of these in turn. First, on the ability to ring-fence. This has much to do with taking steps to enhance banking supervision. The ability of national authorities to maintain barriers to cross-border flow of bank capital and liquidity stems from various gaps in provision in the EU single rulebook. Examples of such barriers include the inability to allow capital relief at the subsidiary level, even if there are explicit solvency guarantees from the parent in another EU jurisdiction, and the refusal in some EU jurisdictions to relax large exposure limits for cross-border intragroup transactions. Not only does this fragmentation along national lines hinder private risk sharing across the euro area, it also reduces the SSM's ability to push for further risk reduction in banking. In important areas, such as the proper classification and provisioning of legacy assets, overseeing banks' corporate governance, imposing penalties for non-compliance, or overseeing major acquisition, the ECB still fundamentally lacks the direct power it needs to conduct fully effective banking supervision. But the good news is that many of these impediments, both to cross-border flows and to strong oversight, can be fixed at the technical level. In many cases, by amending the so-called single rule book, the package comprising of the Capital Requirements Regulation, the Capital Requirements Directive, the BRD that I mentioned before, and the Deposit Guarantee Schemes Directive, and the attendant number of technical standards. As I mentioned at the outset, much of this work can be done within the confines of the current political consensus, in my view. We are not, again, talking about treaty changes. We are talking about letting the technical experts hammer out mutually acceptable compromises. Nonetheless, I have been in this business for more than 30 years, so I am under no illusion that there will be significant resistance from vested interest. Of course, there will. Change will not be easy, and one can expect many battles to play out here in Brussels and other capitals over these issues. The key, I believe, will be for all parties to remember that a more integrated banking market will offer substantial benefits for all. It is not a zero-sum game. Let me turn to the second axis of attack, a set of concrete steps to reduce countries' incentives to ring-fence. Principally, in my view, reducing such incentives requires steps to further improve and harmonize bank resolution arrangements. We can agree that bank failure needs to be handled within a unified, transparent, and predictable framework, one that protects financial stability while minimizing cost to the economy, surviving banks, and taxpayers. We can agree that bail-in must indeed become the norm and bailouts the systemic exception. The challenge is how to get there. Solutions are already in train. For the larger, more complex banks where contagion can be a real concern, there should be enough loss-absorbing liabilities. This is the BRRD's minimum requirement for own funds and eligible liabilities, the so-called MREL, M-R-E-L. That will mean that undercapitalization can be remedied by equity write-downs and debt equity conversion without burning senior unsecured debt or uninsured deposit. And in cases where the least costly solution to protect insured deposits of failed banks requires some public support, such support should come from the common resources of the Single Resolution Fund. In such way, individual member states will be protected from having to shoulder the cost of banking failure. And that, in turn, will help soften the need for ring-fencing and self-protection. So the path to borderless banking, I would say, rests also on step to achieve a better bank exit framework. We are not there yet. The recent experience shows that the system still permits bank liquidation under national procedures that vary widely. It also reminds us that the EU state aid rules still allow national governments to provide taxpayer money to banks in liquidation, subject to burden sharing requirements that are less exacting than the BRRD rules. I'm tempted to call this a loophole. So, in exit policy, as in bank supervision, there is still plenty of technical work to be done. Rather to going into all the details, let me just say that we, the IMF, have just completed what we call a financial sector assessment program for the euro area, something that we do for all individual countries. Periodically. We've just done one for the euro area. I am told by people in European institutions that this is rapidly becoming a must-read for those interested in how to upgrade the resolution framework in Europe. So it's on the web. It's a place to go to if you're interested in the details. Let me emphasize one specific action that goes beyond technical change and requires political support. That is to secure the much discussed common backstop to the Single Resolution Fund. It is encouraging that the June summit requested detailed proposals in this area. To be frank, I will not argue that such a backstop will be an immediate game changer for bank resolution. A few back-of-the-envelope sums shows that it would not be called upon in anything but a severe crisis, and such a crisis is not in our baseline. But it is symbolic, it is important nevertheless, as a further step toward curbing national incentives to ring-fence, and it rightfully belongs in a well-designed resolution toolkit, and we strongly welcome it. Ideally, the backstop should be last and automatic, allowing the Single Resolution Board to draw in a short notice and without condition. So we hope our European partners are going to move decisively on this along these lines in the coming months. I noted earlier that we also in the IMF strongly support early adoption of the European Deposit Insurance Scheme, or EDIS. Here, however, reaching agreement will need to overcome multiple obstacles, including at the political level. Some of the strongest banks in the euro area fear that the contribution of EDIS will end up financing losses at weak banks elsewhere. In addition, as you know, some governments in the member states with a stronger balance sheet worry that EDIS could become a system of permanent state-to-state fiscal transfers through the back door, transfers that are explicitly forbidden under the treaties, despite it being, in the first instance, a privately funded scheme. In principle, Both concerns can be addressed by risk-based insurance premia properly calibrated. Nonetheless, my own personal views is that the political realities means that progress on EDIS will require parallel progress on reducing the pervasive home bias in banks' holding of home country sovereign bonds. And this, as you know, is a complex, contentious area, not one I can go to justice to today, but this to me seems to suggest that this is also something that will take time, and this is nothing that we hope, but we do not expect significant progress in the short run. Before I conclude, let me briefly return to non-bank finance. This is, of course, an extremely broad area spanning everything from financial market infrastructure to securities underwriting to insurance, with much in between. In some areas, such as mutual funds eligible for marketing to retail investors, Europe is already a world leader. In others, such as harmonized financial reporting, there remains more work to be done. I cannot do justice to the multifaceted challenge of developing and integrating non-bank finance in Europe in the few minutes I have left. After briefly noting that initiatives range from corporate insolvency harmonization to SME securitization, let me just focus on one specific and important part of the topic: regulatory oversights of the securities and derivative markets. As I mentioned at the outset, these markets are uniquely well developed in the United States. I shall not claim to be an expert on why this is. Perhaps it has to do with the long US history of banning commercial banks from engaging in securities underwriting under the Glass-Steagall Act, which is in sharp contrast to the European model of universal banking. Perhaps it reflects the strong federal powers vested in the US Securities and Exchange Commission for the security markets and in the Commodities Futures Trading Commission as far as derivatives are concerned. Whatever the answer, it seems clear to me that the European Capital Markets Union endeavor could benefit from further study of the US example as part of its ongoing search for a guiding framework. Allow me to offer one related observation in this regard, and I'm almost done. I think it's important to bear in mind some basic differences between banking and capital markets oversight. In banking, the mandate is to ensure safety and soundness, meaning to reduce the risk of failure. This is pursued through restriction and, more importantly, through prudential supervision to proactively limit risk-taking ex ante. In the capital markets area, in contrast, there is no mandate to reduce the likelihood of failure. Here, the focus must be on ex post punishment for breaches of conduct of business rule, focus on truth, transparency, and disclosure. One question that arises to me in this regard, I think, is whether Europe needs a centralized financial market agency. At present, the European Securities and Securities Markets Authority, ESMA, is mostly a standard-setting body with direct regulatory authority only over the rating agency and trade depositories. In every other area of the European securities and derivatives markets, regulation and enforcement remain national competencies. Has this resulted in a push for national champions and a race to the bottom as once was the case in banking? I don't know, but that's a question to ask. Is there therefore a case for a super ESMA vested with broad pan-European regulatory powers? To me, again, the answers to these questions are not obvious, but I think they need to be asked. As the thinking advances, I would like to inject one more cautionary note. Despite my general advocacy for strong financial sector oversight, there remains a role for a light touch in some areas. There is, I think you know that, a concern that's doing the rounds that as the country with the deepest financial market and financial market expertise exits the EU, the UK, there is a concern that a certain heavy-handedness might take root in the supervision here. I think it's important that one carefully follows this. Okay, let me just wrap up. My basic premise today has been that scarce political capital must be used well. I've identified finance as the key area where we should push. Meaningful progress here is within reach. Here I believe that much of the necessary work can be done within the confines of the current political consensus. As I have said, I think to a large extent we are talking about complex but technical issues. Again, I don't underestimate the resistance from vested interests nevertheless. In banking, the task is to further strengthen supervision and resolution. To be concrete, the task is to systematically remove the remaining national fragmentation from the single rulebook. This will maximize the effectiveness of the new framework in controlling excessive risk-taking and will ensure robust risk-sharing when banks fail. And that, in turn, will reduce the need for individual countries to protect themselves with ring-fencing measures that also act as a barrier to cross-border flows. I believe this can be a virtuous cycle between less fragmentation and more trust. Let me stop here. Thank you very much. I understand we have a few minutes left, but I can take a few questions. But,
There's some time left for questions. Just two questions, quick questions. Anyone? Just, Ernest? Yep.
Thank you for this very comprehensive overview and for the many thoughts. I was wondering, your remark that the IMF favors a central fiscal capacity, what precisely, which form you would suggest? Thank you.
Quick question here too. Keep it brief, please.
Central banks are now buying up a considerable share of sovereign bonds, ranging to 10, 20, 30% of all outstanding government debt sometimes from sovereigns. They're also, via asset purchase programs, are acquiring corporate bonds. Is it not dangerous in the long term to see a systematic increase in this trend? If this continues to go this way, we end up at 40, 50, 60% of government bonds ending up in the hands of central banks. It is not really a dangerously Weimar-like situation. These examples in the past have...
So what's the question?
Is that not a problem that needs to be addressed in time?
Thank you. Two questions. I think that's enough.
Okay. On the first one, on the central fiscal capacity, let me say that, again, we have it on the web with all the details. Our proposal is like a sort of a rainy day fund that builds up. But I think the point, one can do this in many ways. And I am keen always to emphasize that the concrete design is less important than the basic premises, which I think is important. And this is this risk sharing and risk reduction going hand in hand. That the access to this fund, the use of this fund, is contingent on some compliance with the fiscal rules. The fact is that there will be no political consensus for this. I mean, there is no political consensus right now. But over the longer run, I don't see a political consensus for this without this going in hand in hand with a stronger enforcement of the rules. So this is our point. I mean, it is, in some ways, we have taken a cue from the playbook on deposit insurance, right? Where the plans for deposit insurance, or it's recognized here, all you have risk reduction, risk sharing needs to go hand in hand. You're not going to get full-scale deposit insurance before you have dealt with the legacy assets, for instance. So it's a bit the same that if you want to bridge this political divide, you need to have both elements there. But the exact modalities for how to doing it, I think that's less important. So, I don't agree with your basic premises. I think that central banks are doing exactly what they should be doing. Central banks have been concerned about low entrenched inflation. Central bank have focused on their mandate. I'm talking about the ECB now, on making sure that inflation returns to the target. I think they've done it exactly the right way. In the process, we should certainly keep an eye on financial, on stability risks, and while there might be some real estate markets locally in Europe that are getting a bit hot, we do not see such risks. We do not. We do not think that at this stage the monetary policy of the ECB and the monetary policy of the central banks, big central banks, are associated with any serious financial stability risk. And the risk, the sort of local risk that are there, we think that macroprudential tools should be employed to deal with them. I don't agree with the basic premise of your question. Okay.